Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
I just want to persist with you, Gautam, on this point. See, it's your report I'm reading, and you are saying that Nifty is trading at a forward P of 18.8 times, and this is at a 21% premium to its long period average. The Nifty price to book is at 2.8 times, and that is 8% premium to long-term average. While it has every right to be at new highs, does it have a right to be at this high highs?
So Lata, there are two ways to look at it. When you look at averages, there are always some distortions. Look at Nifty's composition, how it has changed in the last 7-8 years. You used to have telecom, capital goods, oil and gas at 8 to 10% weightages in Nifty those days. Today, you have 80% of the index comprised of private banks, financials, consumption, auto, and IT, right? Now, these are sectors which always trade at a higher P than the cyclicals because they have a higher ROE and slightly more structural trajectory to their growth. So while from an academic viewpoint, you can always compare the averages of today's P versus 10-year averages. Given the way the Nifty composition has changed in the last 10 years, those averages are not as relevant today as they may be 5-6 years back. That is point number one. Point number two is, when you are at an inflection of earnings, see today I am far more confident on earnings recovery at any given point of time in the last 3 years than I was. If you look at the commentaries of corporate lenders, which have been the biggest disappointment, by the way, if you look at Nifty earnings growth itself for last 3 years, excluding these 3 banks, so you are still looking at 47 Nifty companies put together. The earnings growth was 10% in FY16, 17% in FY17, 10% again in FY18, and we are projecting it to be 17 and 18%. So the numbers 21, 26, while they look disproportionately high, they are bumped up because of the extremely low base of these 3 banks and of course Tata Motors also. So market will obviously precede the earnings up move, and that is what we are seeing. You have seen the rally extend after the last quarterly result season got over despite so many worries on the global front, Turkey, currency, crude oil, global trade war concerns. So market is climbing a wall of worry because it is forcing an earnings recovery in a lot of sectors.